Now we have Alexander Scholz on stage. Hi, Alexander. Good to see you.
Good to see you.
Thank you very much to have you on stage today for our second edition of Forum of Excellence. We had a big picture on globalization, so we will go from this big picture of politics and globalization to the big picture of real estate. And you will give us some insights on a global level on risks and also chances on international real estate markets. Good to have you here. Currently, you are heading product management at Patrizia. So I think you are have a good link to what's going on in the market and how do you develop your products at Patrizia from its background. You're an alumnus of IREBS. This is fantastic. So you have your PhD and your MSc at the University of Regensburg, and also Alexander is holding an MSc of University of College of Dublin. So we have really an expert today in our second slot. Alexander, the stage is yours on the disruption and opportunities, what the macro outlook means for global real estate. Thank you very much.
Thank you very much. Thank you actually for both. First of all, for having me here, and then also for this brief introduction. I'm sharing my screen now. Hope it will work. And you can actually see my screen. Perfect. Okay. Well, the title of the presentation is Disruption and Opportunities, what the macro outlook means for global real estate. And that is basically when we discussed and when I thought about the title, an alternative title could be actually also finding some value in the next market phase. Finding some value in the next market phase. I'm well aware that this is kind of a look into the crystal ball. Nevertheless, I wanted to give you a brief overview of the market and client perspective. So what is going on in the market? What is the investor sentiment? And based on that, really the goal is to give some insights, but also, especially, I think, some food for thought regarding finding some value in the next market phase, because that will be crucial. I mean, if we look at the recent real estate market developments and the current snapshot there, it's quite obvious, and we are all well aware of that both transaction volumes and capital values are definitely decreasing. The global commercial real estate investment volume fell by 55% within 1 year to only $147 billion. And in particular, if we look at Europe, which showed the biggest decline over all regions, we saw a significant decrease of 64% in terms of the investment volume. APAC was less hurt, or showed a less decline of only 20%. In Europe, also there, it's quite clear we see differences in the various regions. So looking at markets like UK, Ireland, Netherlands, where we have quicker valuation adjustments, the decline was definitely less significant. But on the other hand, if we look at markets like Germany, where we have traditionally actually slow valuation adjustments, the investment volume fell by almost 70%. And I think that is something where, I mean, we all learned it during our studies, that there is a difference between the UK model and the German model. And it's probably less of an issue, this difference in bull markets, but in bear markets, actually, this leads to that we do have a accelerating market in the UK nowadays, even though I think last week Oxford Economics forecasted further declines until the end of the year. But there we see an accelerating investment market. In Germany, we do not see this at the moment. Also because, well, in bull markets, every seller is happy if he or she was able to sell the property above the value in the books. In bear markets, it's contrary. Then there is always the question, and most investors also need to go through some investment committee. Why should I sell actually a property 20% below the value in the books? And that leads actually to this diverse picture also within Europe. And in terms of sectors, it's quite clear that multifamily and office sector declined the most with 64%. Though we saw declining investment volumes for all property types. And then coming to the right side and right graph of the slide, when it comes to real estate pricing, we saw further declines in transaction pricing, both in US and Europe, of roughly 20%. And in both regions, actually, the office sector has seen the most hit. Office sector, not only because of the current market environment, but actually also because we have seen a significant growth in working from home since the pandemic. And in Europe, we have effectively a 3-day in office working week. So there are a lot of questions about the future of office. In the US, it's even more severe when it comes to office occupation. And I think we all recognize that, especially in the European market. And probably also there is no question that the non-core office sector is probably the sector with the most significant problems, and where it's not clear where the non-core office sector is actually heading. So looking at our real estate market snapshot, we definitely see there are disruptions, and the disruptions depend on the region as well as on the sectors. But if we actually then have a broader market perspective, there is actually light. Light because there are mega trends we can count on to support growth. So ESG, impact investing, and the fact that energy efficiency is actually no option. It's an absolute must today. Digitalization, e-commerce, smarter buildings, demographic change, urbanization. Though these trends definitely lead to and support our growth, while there are definitely also trends that create significant uncertainty, and mostly inflation, monetary policy, and geopolitical conflicts. So basically, there are various contrary trends leading to, from our point of view, 3 dominating market themes. First, inflation spike. Second, debt funding gap. And third, decarbonization funding gap. And I will explain that in detail in a couple of minutes. But from our point of view, these are the 3 dominating market themes, which of course lead to high-level implications on real estate investment markets. So first of all, the end of leverage core for real estate. That is something whenever we see also there, whenever we see core investments, they are nowadays all equity investments. And they're definitely, for now, I have to say, there is an end of leverage core for real estate. Value add opportunities for real estate are rising. That is definitely the case, especially in sectors which are hurt in near future, or in regions we can count on. There are actually already some value add opportunities rising in UK, in the Nordics, in Ireland. And as a third option, looking at actually at the real asset market, there are accelerating infrastructure investment. There is an accelerating infrastructure investment market. So I would say we see attractive investment opportunities in non-core real estate and core plus infrastructure. And if we look now at the first dominating market theme, inflation may have already peaked, but it is likely to be sticky. What does that mean? Well, the high inflation rate we have experienced over the last couple of months, driven mostly by energy price, significantly by energy price inflation, came already down in the US, in UK, or in Europe. The process is taking longer, but will take place in the course of 2023. Does that mean we will have right away an inflation rate of 2%? No, most probably not, because the core inflation, which excludes actually the energy price inflation, is still around 6%. And if we are not able to reduce it significantly, we will not have an inflation rate of 2% in near term, which the central banks are targeting. So our expectation is that inflation may have already peaked, but it is likely to be sticky. Second dominating market theme is the debt funding gap. So in times of increasing interest rates, lower achievable loan to values, declining property values, refining challenges will lead to more motivated sellers. And this debt funding gap will be largest for retail and the non-core office sectors. So for instance, UK, we see that more than 75 billion of commercial real estate loans will expire in 2023 and 2024, with then naturally also a higher rate environment compared to 2019 and before, when most of them have been originated. But this is not only a UK example. CBRE forecasted actually recently the debt funding gap office owners face in the US, and estimated with 73 billion as well between 2023 and 2025. So that is a severe topic and a dominating market theme. You do not only see in UK, but actually and the US, but you will see it for sure all over the world. And there on the right-hand side, there is the theoretical impact of rising rates on a non-core office property, with capital values decreasing by 20% and lower LTVs, because banks are also more restrict in terms of LTVs, so decreasing from 65% to 50%. In that example, theoretical example, you see a debt funding gap of 50 million. What is for sure is that this debt funding gap will be not so severe for markets or for sectors which have seen also significant value appreciations over the last couple of years, namely logistics and residential. But for retail and non-core offices, we see that as a risk and might lead to distressed sales. On the other hand, actually, this could create great investment opportunities. The third dominating market theme from our point of view is the decarbonization funding gap. Decarbonization funding gap is basically means that CapEx is required and needs to be put into work to actually fulfill and achieve the targets. So there on the left side is a study from Colliers, which estimated the CapEx which is required to meet energy efficiency standards for the European real estate market to more than 7 trillion euro. Also, green CapEx to meet net zero infrastructure and clean water goals must scale up significantly to 6 trillion per year to achieve net zero and sustainable development goals. So basically, the main point here is this definitely creates further investment opportunities, and investment opportunities also you as an asset manager need to have the capabilities to actually conduct the CapEx accordingly. And therefore, from our point of view, you said before, I work at Patrizia in the product management, heading the product management function. This is definitely an opportunity because investors require professional asset management to take care of this and to conduct those CapEx requirements. If we then now turn from the market perspective really to the client perspective and look at the current most recent fundraising activity in the wider market, it's quite clear we saw a sharp fundraising downturn in Q1 2023, both in terms of number of funds and raised capital, and also not only in the real estate space, but also in the infrastructure space, because that shows, and I have left that in, or have outlined this on this slide, because the reasons might be different, but it's actually currently a real asset topic, the sharp fundraising downturn. And we have seen that compared to Q4 2022, which wasn't a record year either, the fundraising volume changed by 60%. In the infrastructure space, again, different reasons, even by 90%. And that is also in line with the current investor sentiment, because investors plan to decrease allocation to real estate even further in 2023. And there was a survey from Preqin, and based on Preqin data, the amount of fresh capital real estate fund investors plan to commit over the next 12 months. There you can see that especially the large investors meaning who wants to invest more than 300 million US dollar, decreased within 1 year from Q1 2022 to Q1 2023 from 26% to 8%. And that is actually the plans for the next 12 months. So the current investor sentiment, the long-term investor sentiment looks quite different. There are various studies, also one from INREF, that 80% of the investors either want to keep their allocation or want to increase their real estate allocation. So what does that mean? I think we see a strong difference or a significant difference between the current investor sentiment and the long-term investor sentiment when it comes to real estate allocations and commitments. And when you look at the various sectors, this is also in line with what we have seen in the market perspective, and where the dominating market themes and implications on real estate investment markets are value-add, opportunistic, and debt dominated the fundraising, i.e. 85% of the raised capital were raised in these strategies, and core suffered significantly in Q1 2023. Again, that is a snapshot, but actually reflects the current market conditions quite well. And you can see there the market conditions and the client perspective matches quite well. When it comes to the investor domicile, I think it's quite interesting that the relevance of European investors for now has decreased only in 2 years from a share from 48% to 30%, so minus 38%. And then on the other hand, APAC investors, the share of capital raised from APAC investors increased from 22% to 35%, so plus 54%. And something which is also quite interesting in terms of the globalization and how is there any home bias? I think there is, especially when it comes to European investors, because for global strategies, the share of European investors as of now was then only for 2022, 6%. So it is global strategies are highly dominated by US investors. And for European investors, there is a significant home bias effect. So if we then come to the 3 key takeaways and the question, finding is there some value for the next market phase? I think the key takeaways is definitely, despite the current market environment, there is still huge interest in real estate investments, especially when it comes to the long-term sentiment and the long-term investor sentiment, meaning for 18 months plus, but also recent events I joined from INREF, from IPE, I can say the discussions with the investors are definitely definitely fruitful, and they have this difference between the short-term and the long-term sentiment, and they definitely also see this non-core real estate investment opportunities. So second key takeaway, value-add opportunities for real estate are rising. This is definitely something which we already see in the market, as I said, in UK, in Ireland, in Nordics. We are currently raising our fund, and there we had definitely also have seen really good investment opportunities with a good income return and a growth return. To be able to handle that, of course, different asset management capabilities are required than in the last decade. Actually, in the last decade, the market was actually supporting each and every property, not each and every, but the property market as such. Now it's the time for you need different asset management capabilities. And then the third key takeaway is that there is more conducive investment environment in the industrial and in the residential sector, meaning, of course, price discovery is on the agenda of each and every investor, and bid-ask spreads are still relevant, but they are still existing. But in these industrial and residential sectors, we have seen the bid-ask spreads narrowed down, and actually that leads already to, well, further accelerating investment markets in these areas, also when it comes to the core space. So that would be my three key takeaways from actually this presentation and finding some value for the next market phase.
Alexander, thank you very much for your speech.
Thank you.
I like your subtitle at the beginning, finding value in the next market phase. Considering there is value in the next market phase, so you give some insights how you as a company will create new products. I think you will create new products with these three takeaways, considering the market. My first question, we are a bit short of time, but one question, how do you think regulation as like ESG is challenging your takeaways, or what the challenges of regulation linked to your how to consider value in the next phase? Maybe how do you see this point?
Well, very good question. I think, well, regulation is a broad term. The regulation in terms of there is the capital regulation requirements for banks, which definitely not help to increase the appetite actually for real estate investments, because the capital regulation requirements will increase, or for banks with CRR3. Nevertheless, I think in terms of ESG, it definitely supports the strategy and also the value, because for now, I think many investors, but also some asset managers underestimate the speed and the impact of the sustainable transformation and the impact on regulation. And therefore, I think those who are ready and really can have a decent decarbonization strategy conducted actually for their product portfolio or for their assets, they will create value from my point of view. But of course, creating value, there will be others who will not create value if they underestimate the impact on regulation.
So your advice would be do your homework on your relations and you are well prepared for the next phase.
It's not all, but if you do not take into account the sustainable transformation and the regulation in that regard, you will face severe issues.
Okay. Then, Alexander, thank you very much for your lecture, for your having you today on the stage. Maybe you will join us for the next 2 hours on the other lectures, and I will go back to Tobias, who will go for our next topic. Thank you very much.
Thank you.
Also from my end, nice to see you again, that you're doing well.